Hey, welcome. Welcome to you all. So a little bit about me is that I am a local realtor here in Lancaster County. I have a real estate firm, a team of 9 of us right now who do various different activities from helping clients to uh, just support for our agents. We also own and manage a real estate investment firm where we buy distressed properties, off-market properties, tax lien properties, sheriff sales, the whole nine, auctions. And we also do buy and hold, so that would be rental properties. Um, and part of what we love to help our clients think through is not just the ability to purchase real estate and become homeowners, but it's also trying to train and educate everyone that we cross paths with how to actually attain to financial freedom. So that's the heartbeat behind this investment seminar, is just to really give a very basic, obviously, depending on where you are in your investment career. This might be covering totally new ground, or it might be elementary for you, depending on how much investment you've already done. But I do think that it's important that we start with the very fundamentals of it, so that you get an understanding, kind of a 30,000-foot view of what we're looking at. And then in the series, we're going to do more of these seminars throughout the rest of the year, and we'll be able to go a little bit deeper into all of the specifics of the different kinds of investments that you can make. Um, so so that's a little bit about me. My team is the Neva Mar Real Estate Group. We're with Keller Williams Elite. And so that said, if you don't mind, Viangeli, since you're on, can you just tell me, like, do you have experience in real estate investing, or where are you at in your journey?
So I'm pretty just at the basic of everything. I am just trying to look into the information to be able to start real estate investment.
Okay. Okay. Well, that's great. I think that's a great place to be. I think that what you'll find in this seminar is that you're going to get a lot of just different verbiage and understanding of the some of the basic principles of investments, which I think will help you to really start to develop a plan for a business model as you move forward. And we just have someone who joined us, Alan Kling. Uh, Okay, so Alan is muted, and maybe he wants to stay that way. That's fine. But welcome, Alan. We will get rolling here. Okay, great. Let me just. Can you let me know in the chat if you received the real estate investment 101 handout? Did you get that? Okay. If you drop your email in the chat there, I will get it emailed over to you. Okay. Um, and so, ooh, great. Thanks. Great. So I'll get that emailed over here. And And so great, yeah. So right now, just to kind of give a quick recap, Alan, is we're just discussing a little bit about who I am, my team, what we do, and then we heard from one of the participants already as far as their level of experience and involvement in the real estate investment industry. So if you if you have any experience, please let me know. If not, you know, we're going to treat this as very much like a fundamental course. So we're not going to go very, very deep in this first session, but as we continue these sessions throughout the year, we will dive deeper into all the different aspects of real estate investments. So cool. I just emailed that to you, Alan, at your Villanova email. Cool. So, okay. Sounds good. Sounds good. Okay. All right. So that said, we're going to discuss a couple different facets of the real estate investment um, uh, industry, and pretty much what we're going to talk about is fix and flips and buy and holds. Those are the two biggest avenues for getting into real estate investments and building a portfolio for yourself. The biggest distinguishing factor between investments that are of the fix and flip nature or the buy and hold nature is the length of time that you hold those properties. Typically, the financing also will differ, and we'll get into that a bit. And also the way that you prospect and find those kinds of deals are going to differ slightly from a fix and flip to a buy and hold. And so in this seminar, we're going to cover types of investments, investment financing, prospecting, and we'll talk about tax sheltering a bit. In next month's webinar, we're going to dive deeper into how to determine ROI, you know, what's a good return on investment when you're buying these properties, as well as ROR, which is rate of return. What kind of rate of return are you to look for when you're finding these properties? So that said, let's dive into the types of investing. So the first one that we're going to look at is fix and flip. Again, like I mentioned, there's fix and flip and buy and holds are your most prevalent and definitely the easiest to kind of break into as you're beginning to get into real estate investing. There's a plethora, there's almost an endless amount of different investment options that you can get into as you become more of an expert in the real estate investment side of things. But I know many a great investor who have made their living in the fix and flip and the buy and hold spectrums. And so the fix and flip model. Fix and flip model, very simply, is a short-term investment. You buy the property with the intention of holding it from anywhere between 6 months to a year. Any more than that, and it really does start to become very unprofitable for an investor. Ideally, we like to try to hold on to properties for about a 3 to 6 month period. And if we really run into issues any more than 9 months, and we're really kicking ourselves for taking that long. So, but in general, what you're looking for in a fix and flip is about a 6 to 12 month commitment. The other thing that you're looking for with fix and flips are profitability in terms of after repair value versus fair market value. So the difference between fair market value and after repair value is that when you come to a property, say you see a distressed property in a particular neighborhood that you like, it seems run down, it seems like it's really in need of some TLC, some tender love and care, right? That is going to be the kind of property that you're going to want to inspect in terms of comparables in that neighborhood to find out what does the neighborhood value support, what do most homes in that neighborhood sell for, and as a result, that number or those numbers, whatever you determine to be the kind of median or the mean for that neighborhood, is what's going to allow you to determine whether or not buying that said distressed property is going to be a good investment for you based on the after repair value. So fair market value is the first indicator as to whether or not a property as compared to its after repair value is worth even looking at. So a quick example of that would be that if you come into a neighborhood and you know that most properties in that neighborhood are selling for around $250,000 on average, a good home in that neighborhood sells for $250,000, and the property itself requires a good amount of work. And the only way that you'll be able to tell the amount of work that it needs is by doing a physical inspection of the property. You really, really want to go in there with either a contractor or a certified inspector and take a look at the property if you can. Sometimes that's hard to do with distressed properties because in a lot of cases they are, in pre-foreclosure, or they are foreclosed, or they're real estate owned by the banks, or they've been abandoned. And so when you see those kind of properties, it might be difficult to find an avenue into that property. But if you can, usually the best and highest and quickest way to get into a property is to build a good relationship with the local realtor in your area and have them do some due diligence for you in determining who owns the property, how much is it worth. A lot of that when I talk about fair market value and after repair value can be worked out with a local realtor who is well versed on the area and the location, right? But once you've done that and you have identified a good property, and you know what the fair market value is based on what it would sell for right now in today's current condition and market, then you inspect the property and you're able to then determine what kind of repair needs to go into this property. Does it need a new kitchen? Does it need new bathrooms? Does it need new flooring? Does it need new walls? Does it need to be completely gutted to the bones and rebuilt, reconstructed? Those are all things that a good contractor, general contractor, can come in and give you a breakdown, a cost estimate of everything that needs to go into that house. So back to that example we used earlier, let's say that the house is being listed or offered at a fair market value of 125,000 per se, and now that's the fair market value, a 125, or the offered value or price, and based on the comparables that you found, you're looking at a 250,000 range for an after repair value. So you have between that about 125 to 250 is going to be about 125, if I'm not mistaken. And so you're going to have quite a bit of wiggle room in there to figure out, do I have enough equity in this property, if purchased for what it's offered at, to do the improvements and be able to make a profit after it sells. And so that's what you really want to determine for yourself in figuring out whether fix and flips are the right option for you. And later in this discussion, we'll discuss what some different tax sheltering vehicles might be for you, because one of the biggest differentiating factors between a fix and flip and a buy and hold is that because fix and flips are short-term investments in which you are making a substantial profit in a short amount of time, you are going to really be penalized by the IRS because they frown upon that. They don't want people to make massive profits in short amounts of times. And so because of that, they're going to greatly penalize you for doing that. And so you're going to see something called capital gains taxes. And capital gains taxes are a thing of the devil, if you ask me. But they're a reality that you really are not going to be able to avoid if you're going to get into the fix and flip world. And so you have to come into this arena ready to be able to offset your profits by sheltering that gain somehow. And we'll talk about that a little bit later. So that's a general overview of the fix and flip model. The other model is the buy and hold model. And so with the buy and hold model, what we will do is look for long-term investments. And I see your question in there, Alan. I will touch on that in a little bit. We have a time built out in towards the end of the segment, and I understand that you have to go. So if you're not around for that, I'll answer your question and you'll get the recording for this and you'll be able to see it again. But the next thing that we're going to cover is the other side of that, which are long-term investments, long-term holds. So we call those buy and holds. They're rental properties, rental units. They're cash flowing assets that you purchase for the purpose of accumulating passive income as a metric for investment. So and so with the buy and hold, you have a couple different opportunities for in infiltrating that spectrum or that market. One of the simplest, and I would say easiest for first time investors, people that are looking to build out a portfolio, is to simply do what is known as house hacking, or another way would be to just become an owner occupant in a property. So what that means is that you uh, we will look at how to get into a property through the buy and hold or the owner occupant model by actually becoming someone who lives in that rental property. So that's house hacking. That's how you can get into learning how to get like buy a property with as least amount of money as possible if you're willing to actually become an owner occupant, right? So that's house hacking. One of the ways you can think of that is, let's say you see a 2-unit, a 3-unit, a 4-unit building, meaning that there's multiple apartments in that building. You can take out a conventional or just a traditional mortgage on up to 4 residential units, and in doing that, you're able to still qualify for your traditional lending options and be able to purchase up to 4 units if you're willing to be an owner occupant without having to put down 25%, 20 to 25% of your money into that investment. And so that is a really, really nice way, if again, if you're willing to take the risk and make the sacrifice to move into the unit yourself for a minimum of a year, you're able to then save a lot of your money. Because let's say, you found a property that you really liked and it was in a rural area. So meaning that it's not in a highly dense or highly populated area, but you really like the location and you really like the property, and you reach out to a local realtor and they give you the rent roll on that property, meaning what the actual profit margins are, what the monthly rents are. And you look at that property and you say, man, I really, really like this investment and I would love to own this property. But man, they're asking, it's a 4-unit, they're asking for 350,000. I don't have 20% of 350, but hey, it's in USDA territory. USDA is a lending vehicle. It's a mortgage option that allows you to buy a rural property, again, up to 4 residential units as an owner occupant with 0 money down. So literally you can buy that property in a USDA setting with no money out of your pocket, except for the closing costs, which are inevitable. If we were in a very heavy buyer's market, you could probably get those closing costs even covered, because USDA allows you up to 6% in seller help. However, the problem becomes is that we aren't in a buyer's market. We're in a very heavy seller's market, and so you can't get away with asking the seller to cover your closing costs. And so, but what you can still do is purchase a USDA loan for this property and get into it with no money down. And now you own a 4-unit, 3 units of which are paying you rent. So now you're living for free and you're cash flowing. And if you live in it for a year, you can move out and keep the property, rent out the unit that you were living in for that year, and refinance, take your equity out of that property that you might have accumulated over a year and do it again. And that's how people house hack, and they buy multi units year over year by doing something to that effect. It's not, again, it's not something that is feasible or possible for everybody to do, especially if you have kids, or if you're if you're just really not in a position to do that. Then it is what it is. So then the other option would be the BRRRR method. The BRRRR method is the 4 R's stand for buy, rehab, rent, refinance, and repeat. So you're buying the property, you're rehabbing the property, you're renting out the property, you're refinancing the property, and then you're repeating that process by taking out your equity and doing it again. So a perfect example of a BRRRR method approach to long-term holds is like, you see a property, that is on the market. And it's, again, it's the way that these work typically is that you want to approach it from a fair market value versus after repair value, very much like a fix and flip. The difference is that with the burr method, even though you're taking a lot of the same steps that you would take with a fix and flip, you're not actually intending to sell this one right away. You're intending to rent it out at a higher margin than you would have been able to before you renovated it or rehabbed it. And then you're turning around and refinancing the property because now it's worth more money. So it's going to be able to be appraised at a higher value. And then once you do that, you're able to take that money out of that property with the rents there that are being collected on a monthly basis to pay your mortgage off. And then you take your equity and you do it again with another distressed property. The burr method is a phenomenal method. It gets a bit nuanced in the sense of knowing how and where to find those properties and how to determine the fair market values, as well as how to make a competitive offer to a seller so that they want to work with you. Burr methods, in my mind and in my opinion, based on experience, are most effective when you can find seller financing options. So what that means is that you're not necessarily, in most cases, going to be looking to go to a bank and say, hey, I have this distressed property I want to buy. Can you sell it to me? Or can you give me the loan to purchase it? And the reason being is that in most cases, those kinds of properties are the kinds of properties that banks don't want anything to do with. And so they're going to give you a really hard time, or they're going to lend you a very conservative number, in which case most times sellers don't want anything to do with that. So a seller financing option is excellent in a burr method approach because, for instance, with seller financing, the approach to it is that the seller, because they've owned the home for so long, for instance, they don't have a mortgage on the home, they own it 100%. So they, in essence, become your bank. They're the ones who can then lend you money because it's built into the value of the home as an equity line of credit. And so what you end up doing is that you essentially just pay your mortgage directly to the seller, right, rather than to a bank. And then the seller in turn has a lien on the property, so that if you default, no harm, no foul, they just take their property right back. But the deed is transferred and you do become the legitimate owner of that property through the seller financing option. And in that scenario, then you can do the burr method rather quickly. And so that's the burr method. And that would be one of two ways that you can do buy and holds fairly cheaply and effectively and efficiently also. Um, then from that point, so now we know, like, stepping back a bit, we know what types of investments we're dealing with now. We're dealing with fix and flips and we're dealing with buy and holds. And we know that with the fix and flip models, we're dealing with fair market value versus after repair value, and then determining whether there's enough after repair value built into that property to be able to make a profit after we calculate the cost that it's going to take to repair the property. So that's the fix and flip model. The big thing with the fix and flip model, of course, like I mentioned earlier, was that you're going to be facing capital gains, which means that you're going to need to figure out a way to offset the capital gains that you're going to be making on that property, the profit, so that you're not penalized, because capital gains are in excess of 35%. So they're very, very hefty, and you will get an incredible bill from the IRS if you don't know how to offset those capital gains through a tax sheltering vehicle. So that's the fix and flip. And then we have the buy and hold, the house hacking method, or the owner occupant method, where you buy the house by living in one of the units and then having the other tenants pay you. That's a really popular one. The other one is the burr method. So where you buy, you rehab, you rent it, you refinance it, and then you repeat the process. So that's the burr method. Some financing options, okay? So when you're looking at these investment options and the different types of investments that you can get into, you have to consider, how are you actually going to finance these deals? How are you going to get the money to make the purchases, to make the improvements on these properties? You have to have a good plan in place for financing. And so some different financing options are your traditional models. So you have traditional financing options such as a mortgage, right? Everybody knows that mortgages are the most popular and most common way to do investments or more or purchases of real estate. So mortgages consist of things like conventional mortgages, FHA mortgages, USDA mortgages, VA mortgages. There's rehab loans such as the FHA 203K, which allows you to be able to purchase a distressed property and then borrow the money that is required from the bank to then do the repairs. The FHA 203K is a little bit difficult to navigate, if you will, because it does require the bank to approve of all the contractors and everyone who's working on the project. And so from that perspective, you have to make sure that you have contractors that are licensed and that are approved by the bank, which can become a little tedious, especially if you don't have a good connection with a good contractor. So, but there's mortgages, right? That's a traditional financing option. Another traditional financing option is like a HELOC. So HELOC is another term. It's an acronym for home equity line of credit. And as a HELOC, you can borrow the equity that's in your home. So for instance, if you're a homeowner, and let's say you know that you have, let's say $100,000 in equity in your home, there's a pretty good chance you have a good amount of equity in today's market because homes are appreciating at such a rapid pace, that there's a good chance you could go to the bank and that they're going to lend you money on your home as a home equity line of credit. And so you want to look at banks that offer a 100% loan to value. So what that means is that if you have $100,000 in equity in your home, you want a bank that's actually going to lend you $100,000, not a bank that says, "Oh, we only do an 85% loan to value." So now you have 100,000 in equity, but they're going to be a little bit more conservative and only give you 85,000 of that 100. Now, maybe you like that because you don't want to liquidate all your equity. But I would tell you that in this market, it's better to liquidate all of it than to leave some of it tied up in your home. Because if we do come into a market crash per se, and that equity that equity gets depleted from your home, now you don't have any access to that equity. But if you have it tapped out in a line of credit, then at least your equity is not sitting static, but it's liquid, and you have the ability to access it. Even if your home has been depreciated, you'll still be able to access the home equity line of credit. And worst case scenario is that if you sell the house, you'll have to make up some of the difference. But if you keep the house and you keep the home equity line of credit, no harm, no foul. Once your home appreciates again and comes up in value, you'll have the equity again tied up as a collateral against your home. So I love home equity lines of credits. I think they're phenomenal vehicles for getting into investments. I recommend them to people. I've used HELOCs. I think that they're safe. You don't have high interest on them, and they're just great vehicles. So if you have equity in your home, consider a home equity line of credit as a way to use financing for your next deal. Another one is obviously just cash. If you have cash, sometimes you look at, if you have a really great 401k option. Some 401ks allow you to tap into them if you have like if you're buying a property or real estate or your first home or things like that. You have to really discuss that with your financial advisor and your 401k company. But I know that 401ks are a quick way to again, very much like a home equity line of credit, liquidate some of that money that's just sitting there waiting for you to retire, to use it now so that you can make more money on that money that you've invested into that 401k. And that's a way that you can get cash. But so those are some of the traditional models. There's others. You can borrow money from a family, a relative, right? There's those are some other traditional routes. Gifts from parents, from grandparents. Those are all different kinds of ways. There's also some non-traditional financing options. And so what some non-traditional financing options would look like is something called hard money. Some people are not familiar with hard money. What hard money is very basically and very simply is just a loan that a loan shark or someone who is out to make money by lending money apart from the traditional bank model in which they're requiring, your 2 years tax returns, your credit score, all these different things to make sure that that a bank is protected. A hard money lender is typically not as concerned with all those things. They might look at your credit score, they might want some tax returns, but typically what they're more concerned about is the actual asset that is being purchased. The deal that you're pursuing is what gets them excited. Will there be money for them to make money on the deal that you're doing? And if there is, they'll lend you the money. Typically, hard money lenders want anywhere between 10 to 20% down so that you have some skin in the game. But the nice thing about hard money is that you get the money right away. So it's as good as cash in a lot of ways because, let's say you are in a competing offer situation. If you have the ability to say, hey, I'll close next week, that's going to allow you to get deals done quicker. The one downside to hard money is that it's expensive. Typically, you're looking at anywhere between 10% in interest only to as much as 25% in interest only. And it can become very, very expensive for people. But again, if you're doing like a fix and flip option or a quick BRRRR method approach where you're going to be looking to refinance the property as soon as you rehab it, then a hard money loan might be the way to go because you're not going to be holding on to that property for a long time anyway. So paying the interest might be worth it for you in that regard. And that's where doing your due diligence and running the numbers and making sure that it all makes sense for you is going to be worthwhile. The other option for non-traditional financing is like seller financing, like I mentioned earlier. So seller financing is when a seller who doesn't have a mortgage on a property is able to be your bank for you. Essentially, they're not actually giving you any money, but what they're doing is that they're giving you money in the form of the house as a collateral. So what they're saying is, hey, you can buy this house for me for $100,000, and essentially they're going to want 20% down. So that means you're giving them $20,000 up front in a lump sum, and then the difference of that, the $80,000, is getting amortized and is going to get rolled out into like a 30-year payment. And then whatever that ends up being after you calculate your principal, interest, taxes, and insurance into that cost, then you're going to pay that monthly fee to your seller. And that seller is the bank. Now, the seller in turn is going to have a lien on your property so that if you default, very much like the bank, they can take their property back. But just like when you're dealing with the bank, you do become a real owner of that property now, and you can use that property now as leverage to go get out a home equity line of credit or other options because you do actually own it. It's just that the seller is the one financing it for you, not the bank. And so those are some different financing options. There's many more variety of financing available, but I would say that those are certainly the most popular within the traditional and non-traditional routes of financing. So we're covering a lot of ground. I hope this is helpful. We're definitely making some headway here. What I'm going to do here, if you're okay with it, is I'm going to take a quick, just 2-minute break. I'm going to pause the recording and I'll start it again. I'm going to grab some water if that's okay with you, and I'll be right back. Okay. All right. So sorry about that. Getting back into this, we are now looking for options for finding deals now, right? So we've talked about the kinds of investments that exist, the fix and flips, the buy and holds. We talked about the different methods within the fix and flip and the buy and hold, such as the house hacking and the BRRRR methods. We've talked about financing and how you can actually finance the deals that you are seeking to take on. So we have the traditional and non-traditional options, but all of those things are extremely important. But if you don't know how to actually find the deals, then it really does become a kind of it really does become pointless at that point, because you can have all the right tools, but if you don't know where to find the properties, then how are you actually going to get started? So prospecting is the next kind of step that you want to consider. In the prospecting model, you have to figure out a good system for finding deals, for curating lists, for being able to make phone calls or send letters, or to identify neighborhoods or areas that you want to target so that you can allow yourself the opportunities to get in front of potential sellers or people that will give you the deals for the kinds of investments that you're looking to obtain. So one of the quickest and first steps you want to do is identify a neighborhood or geographic area that you want to target. So if you're, in our scenario, for instance, we're in Lancaster City. So if you say, hey, I want to target Lancaster City, or I want to be in the 6th Ward, or I want to be in Chestnut Hills, or whatever, you determine the geographic areas, or you say, hey, I want to be outside of the city, Manheim Township, in Penn Manor, in, you name it, different school districts, different townships, whatever. Or you want to be in specific neighborhoods. Hey, I want to be in the Meadows, or I want to be in, Cross Gates, or I want to be in Hawthorne Ridge, or whatever, and whenever you start identifying the areas geographically, the neighborhoods that you want to be in, that allows you now to be able to put lists together, I should say, that allow you to create a mailing list or create a call list, because then once you know the neighborhoods and the areas, you can start to actually find addresses and the names of the people that live there, and create a sort of a templated email or a letter that you can print out and stuff in an envelope and send out to these homeowners. And it's going to say something to the effect of, hey, I came across your property. I really am interested in purchasing your property. If you have any interest in selling, please let me know. We can give you a cash deal, and we can close quickly, and something to that extent. And typically you've done your due diligence to figure out what you want to do is determine, like, are the people you're contacting actually people who would have an interest in selling. So what that's going to look like is, figuring out how long has the person lived there, how many years have they been, how much equity do they have, are they in lieu of foreclosure, are they in lieu of short sale, what kinds of things are you looking for. And the way to determine that is looking at things like the public records. You can find these kinds of lists through, like, the sheriff's sale website, the recorder of deeds, the Lancaster County Courthouse, or whatever courthouse you're a part of in your area. And so finding these kinds of lists will allow you to determine who you should be prospecting to. And so you can send a letter of intent to people that you want to purchase, or you can create a mailing list, or you can create an email list if you can find the emails to these people. There are certain kinds of softwares out there that you can use. One of them being like Batch Leads. Batchleads.io is the website. You can buy a subscription to their website and to their database, and they give you names. They allow you to create entire lists based on zip codes, based on distressed properties, for sale by owner properties, short sales, expireds. That would be people that wanted to sell at some point, but their property expired, and so maybe they still have interest in selling. This is a lot of the ways that we're finding properties, and so you can do that. You can do if you have a good relationship with the local realtor, you can ask them to give you a list of different names in certain areas, or to give you access to their MLS through their portal. And in that way, you can use certain tools such as the search criterias to like print out mailing labels, or you can use like Remine is another software that allows you to really mine data and to find certain facts about homeowners and areas and all of that. Some people use Zillow. Zillow allows you to find for sale by owner properties and other things like that. So the first thing is, obviously, in prospecting, is you have to determine your target audience, and in finding that target audience, then you have to figure out how to actually reach that target audience. Am I calling them? You should be cold calling. You should be sending mailers. You should be doing emails. And in doing all those different things, you become a repetitive kind of voice to those potential sellers. And so in doing that, you have a higher likelihood of getting calls back or getting people to reach out to you to sell their properties to you. So, but of course, you want to make sure that before you do all of that, that you have the financing lined up, that you have the ability to actually execute on your promise, or else you're just going to get people, calling you and upset that you don't actually have, you have no ability to perform. So that's not good either. So, obviously in that, you're, like I mentioned earlier, you're determining your fair market value and after repair value of all leads to determine whether they are worth pursuing, right? So as you're curating these lists and putting them together in these areas, what you want to determine is, as you are looking at the kinds of houses you're wanting to buy, is there going to be enough money at the end when it sells? Is there going to be enough money there to be able to get the kinds of returns that you're looking for? If not, then I don't know that it's really worth pursuing that. But in either case, that's something that you want to do with every property, is determine your fair market value and the after repair value, and what's the difference there? Is there enough return? And then you always want to know your numbers. You never want to make an emotional buy. You never want to just buy because you like the area or you like the home or you think that it's going to be a good deal or whatever. You want to be very objective about your home purchase when you're doing investments, because again, these are not going to be a home where you're buying it for sentimental value or to build memories, and you're buying these for the purpose of becoming a business and becoming profitable and acquiring a portfolio. So never make an emotional buy, and always, 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 especially when you're looking at buy and holds, make sure that there is cash flow from day one. You want to make sure that there is cash flow available in that property, meaning that as soon as you own and buy the property, it's already making you money. You don't want to buy an investment that's costing you money. Fix and flips cost you money up front, but again, with a short-term turnaround, you want to make sure that in 3 to 6 months tops, you're able to recoup all the money you spent plus a profit. And typically, a rule of thumb is this: is that on a fix and flip, if you can't make a minimum of $20,000 on that fix and flip, it is not worth it. Okay, if $20,000 is the absolute minimum that you want to look for in a fix and flip. Obviously, any more than that is incredible. We typically, when we're looking for fix and flips, we're looking for about a $60,000 profit margin. If we can make $60,000 on a deal, we feel that that's a good investment. But again, don't ever, ever, ever buy an investment property that's a fix and flip in which you're going to be making less than $20,000. Just not a good investment. And then for fix it or for buy and holds, the cash flow is king. So your cash flow is going to be your NOI, which is your net operating income, minus debt service, which is essentially what your net operating income is anyhow. So it just means that your net operating income is going to be all of your expenses, utilities, taxes, all of that. And you subtract that from what the rent rolls are, how much money it's making. That's going to be your net operating income. And then you subtract that from your debt service. Your debt service is your mortgage. How much money are you paying out to the mortgage every month? And then whatever the difference is, that's your cash flow. So as an example, let's say you're making $1,000 a month and your expenses on that $1,000 a month is $200 a month for utilities and all the other stuff, and then you have another $700. So now you're all in at $200 on, or I'm sorry, $900 on one unit. Well, if that one unit is bringing in $1,000 and you're paying out $900 every month for the entire investment, well, you have $100 of cash flow on that one unit. Now, if you have a 2 unit and you have another 1,000, now you have $1,100 in cash flow, because now that one unit itself takes out all of the debt service and the costs, and now you have an additional unit that brings in nothing but cash flow. So you have $1,100 of cash flow. That's it. That's phenomenal. All right. So anytime that you can look at having a buy and hold scenario, make sure that there's sufficient cash flow, even if it is small. It doesn't matter if it's $100 a month. At least it's not costing you anything. You want to make sure that the property is not costing you anything. Even if you're breaking even, I wouldn't advise that. But the fact is that you still have an appreciating asset that is costing you nothing, and that when you sell it is going to make you money. But the best case scenario is that it's making you a good amount of residual passive income every month, and it's also going to be able to be sold for a good profit when you go to sell it. So that's that. Like I said, next time when we jump back on for our next seminar, we're going to dig deep into ROI and ROR. So return on investment and rate of return, and what are good return on investments and what are good rate of returns to be looking at. So we'll dig deeper into that the next time around. Tax sheltering is another thing that I want to talk on very briefly. I'm not going to go very deep on this because, again, I think that we can dig deeper in a later session. But what I will say is that one of the biggest and best, and I would say safest vehicles for tax sheltering is your 1031 exchange. The 1031 allows you to offset your capital gains, your profit, by investing it into another real estate asset. And so, for instance, let's say for us, for instance, if we make $60,000 on an investment, well, we're going to take that $60,000 and we're going to buy a property in which $60,000 equates 20% of the value of that property. But the property that we're buying is actually a cash flowing rental property. We're not buying another fix and flip, right? We're buying a cash flowing rental property. And in buying that cash flowing rental property, we now have $60,000 of equity in that property because that's what we put down for it. But what we now have the opportunity to do is to refinance that property and cash out our equity, or our equity as a line of credit. So now that profit of $60,000 we have in a line of credit, but we didn't have to pay any taxes on it because we were able to offset it by purchasing another property, so that in the government's eyes it looks like we never made any money because we spent the money right away. And that's what the 1031 exchange is, in a very basic explanation. If you have more questions about the 1031, I highly recommend you talk to a qualified accountant or a lawyer. We have access to different lawyers that are 1031 experts or accountants, so we can get you in touch with that. But definitely recommend you talk to an accountant or a lawyer. But that's pretty much it. I hope that was helpful. I know we covered a lot of ground. I know that if you're newer into the investment space, it's gonna feel very, very extensive and maybe even overwhelming. But we're here. We want to answer questions. We want to help you. We want to figure out how to become an asset to you and a consultant to you. So if there's any way that we can be helping you as you're exploring your investment opportunities, we'd love to do that. Let me look here. We're gonna open it up to some Q&A quick. Alan had asked a question. He had asked, can we just write off all the improvements in the property? Oh, yes, you can. Yes, you can. You can definitely write off the improvements. The problem is that no matter what, with a fix and flip, you've already accounted for all those anyhow. So for instance, that's where getting that contractor involved is going to help you to determine, okay, if I'm buying the house for 100,000 and there's $50,000 in cost and I can sell it for 250, well, that's $100,000 profit. Well, you're not going to be able to write off that $50,000 per se, because you're still, what they're taxing you on is that $100,000 of profit. That $50,000 has already been accounted for before you even purchased the property, because you already knew how much it would cost you. So you definitely can write. So like with a buy and hold, you have a depreciation calendar or schedule that you can follow, which allows you to write off any costs or expenses. So the beauty of buy and holds is that you can really offset all of your costs and actually end up paying nothing in taxes for the year, and you really can't do that as easily in a fix and flip unless you do the 1031 exchange. So I hope that's helpful to you, Alan. Um, okay. Okay. Hardest part for me. What's the hardest part for you, Viangeli?
Finding the properties, like we were talking about, the prospecting and that aspect of it.
Yeah, yeah. It's tough. It's really tough to find those properties, especially in a market like the one we're in, because there is such a shortage of available properties for sale. Plus, with COVID, there has been such a great kind of leniency extended to homeowners as well as landlords, well, not so much landlords as much as renters, really. But where foreclosures are not being required right now. People have forbearances that they can, wait to pay off their mortgage in back pay or whatever. So there's different vehicles for that. And so because of that, COVID has been really a help to a lot of people who've been financially impacted. And so I know I've had a lot of people ask me about like, hey, are you going to be, are you expecting to see a wave of foreclosures and all these different things? And are we going to have just is it going to be like a madhouse of like just so much inventory? It's like, no, I don't believe that, because again, there's a lot of people that are catching up on their forbearance, their past due mortgages, and there's a lot of leniency out there. And so I do think that what we're going to see is that there's not going to be a huge wave of foreclosures or short sales like we would have anticipated because of the laws that have been passed due to COVID. But there's still options out there for finding off-market deals, and I would highly recommend you look into batchleads.io. I think you'll find that they have a really good system and database that will help you. Remine is another good one. The public records is another good one. So they're out there, but yeah, it is tough to find them for sure.
Yes, definitely.
Nice. Well, do we have any other questions?
I think I'm good.
Okay. All right. Well, was this helpful to you? Do you feel like you were able to take some stuff away from this?
Yes, absolutely. Especially with like the different kinds of financing and stuff like that. So I have a whole bunch of
Mhm.
notes to review.
Okay. Well, if you have any questions, you have my contact information, so don't hesitate to reach out. I appreciate you tuning in. And if you enjoyed this, please do, tell others about this and see if we can be a help to other people, and make sure to tune back in for our next seminar. Okay.
Awesome. Definitely will.
Awesome. Well, hey, thank you guys so much. You guys have a great day, and we'll be in touch. All right. Bye-bye.